Bill Baruch is back. He is the president of Blue Line Futures. Welcome back, Bill. Lots to talk about with the markets. We missed you.
Thanks for having me on again. It's great to join you.
Stock markets. Let's talk about that and start with the broader equity markets. Now, we've had a bit of a fall from the peak in the S&P 500 in mid-September. As an investor, some might ask you, well, Bill, is this drop going to continue? Or can we see a bottom anytime soon? Basically, should we be selling our positions now?
No, I don't think so. Let me say first, risk management is important. And, there's been, we had a little more cash than normal going into the last couple of weeks. I've used protection for clients and portfolios, whether it be, in the Qs or SPX, been trying to protect some downside. So risk management is always important, but I don't see a reason to be, unloading stocks at a high clip here. I mean, if anything, you really want to be looking at for a buying opportunity if you aren't fully invested. And that's what we've done with new clients, throttling them into positions. But I put a note out to clients in my regular morning note and said, it's a fresh start. It's a new quarter, it's a new month, it's a fresh start. And I went through, all the narratives, all the headwinds we've seen for the last couple of weeks, from quadruple witching and quarter end to Evergrande, the Fed taper, Congress, and laying it all out. But at the end of the day, there's a number of reasons why I'm still bullish stocks.
Okay, so you don't think this is the beginning of a new bear market? I mean, new month, new quarter, new bear market, perhaps?
No. In hindsight, you look back at seeing what the S&P did. When this market sold off last week, the rebound went right to that trend line that it broke, and it's been a very technical market. I was looking for an area here, 42.75 to 42.95 to hold. I know some people were looking at 42.60 to 42.70. And so whatever your technicals are telling you, so far, there's been a big level that's held here in the market. But can it do it on a weekly closing basis? And I think we need to see it here this first day of the month to get a nice, good close here on Friday to get some good momentum going into next week.
What are some of the risks, the market risks that have, quote unquote, spooked investors over the last couple of weeks? Was it news out of China? Was it the debt ceiling debacle? Was it maybe it was just due for a healthy pullback? What do you think?
I think first, yes, due for a healthy pullback. Market was moving really just aimlessly higher. And once we broke through the 50-day moving average, once we broke that trend line that's been there for a while in the S&P, it did open the door for a larger scale correction, that 5% that we haven't seen in quite a while. There's been a lot. Evergrande was something that was under the hood through that quadruple witching week. That definitely was a reason for some additional risk off. You did see that some of that selling into that quad Friday where the market broke, and then behind everything else, into the next week, you had Congress deadlock. Janet Yellen, the U.S. Treasury Secretary, was definitely instilling some fear out there to Congress, and it worried the markets. And if the U.S. were to default on its debt, the Fed is going to taper, and that was something that was. Is there a taper tantrum going on? Obviously, you mentioned China. There's Evergrande. Some people are saying that the energy crunch that is taking place could be a bigger deal than Evergrande itself. So. Inflation is there. Costs are going higher. And one thing that noted yesterday that I think was ongoing weakness throughout the session was Bank of America downgraded Kohl's. And Kohl's is a stock that we own. I like it. I don't dislike it now just because it was downgraded. I think there's good levels in it to be looking at. But I like Kohl's as a stock, and they downgraded it because of supply chain disruptions. You saw a lot of these retailers that got hit really hard over the past week because of that, from Macy's and Nordstrom's, Target. Target's 15% from its highs. So there's been this correction that's been going on through leadership because of inflation, supply chains, and a number of reasons that I've mentioned here for a while.
You mentioned the possibility of a U.S. debt default. Well, I think it's fair to say that such an unprecedented event could trigger a major correction or sell-off. So I'm guessing, because you're still in the markets, I'm guessing you think that is an unlikely scenario for the U.S. to default on debt, right?
I don't think they are. I think that they are playing a really high-stakes game of chicken. And, I don't know anybody out there that really praises what Congress does on a daily basis. So I won't go into worsening that narrative and criticizing them badly. But with that said, I don't feel very strongly about what they do and what they have done. This is a high stakes game of chicken, and really what we saw the stopgap bill passed, but it's really just a little Band-Aid here because we need to get the debt ceiling raised, removed, whatever they want to do, however they need to do it to get it done, because the U.S. cannot default on their payments. And for the past couple months, I was looking at rates to rise. My reason for rates to rise, though, was that Congress was going to get their act together, and they were going to pass infrastructure. They were going to get the debt ceiling done, and then they were going to print more money, as they've been talking about. At the end of the day, they were going to get that done, and more supply of treasuries was going to force the more supply forced prices lower. The Fed was going to buy less, and that was going to be something that forced rates higher. So, at the end of the day, I was right. Treasury yields have gone quite a bit higher. The 10-year got to 1.56 this week, but I was right for all the wrong reasons. And it was actually the Congress that didn't at all get their act together. It's been a circus, and but it's not done yet. They need to get this debt ceiling taken care of, or we will see higher rates, and that's going to hurt the tech side more than anything. So it's still ongoing.
So what sectors do you like right now? What stock sectors do you like?
I've been really adamant that we're going to see energies and we're going to see financials outperform the second half of the year. They haven't, quite done that, up until a couple of weeks ago, and now you're seeing JP Morgan basically within its highs. You're seeing American Express within its highs. A lot of these we own some good regional bank exposure. Silicon Valley Bank, was surging to highs. That I think the financials are going to do very well. We love energies. Companies like Marathon Petroleum and Chevron and Pioneer have done really well. You've seen things like Oxy get upgraded, and so I think there's some really good really good way to look at those being some sectors that are going to outperform. And there's really great names that still have some room to the upside. But I think overall we're looking at value, cyclicals, value that are going to outpace tech. We're seeing that here today. The Russell 2000 is up 1%. The Nasdaq's just a little bit in the red, and that's going to be part of the rising rate theme. I don't know if we had a high in rates here this week for the near term or not, but maybe the rally takes a bit of a breather here. Waiting on some more data, non-farm payroll next week, and then what does Congress do?
Okay, let's just touch on oil one sec, because you brought up oil. You're bullish on energy. You have been for a while. That was a great call, by the way. And Kathy Wood, I want to share one of Kathy Wood's tweets from yesterday. Listen to this. The rise in oil prices this year is a function more of supply than demand. At the turn of the 20th century, whale oil faced the same fate. And whale oil prices fluctuated dramatically. If ARK's research is correct, oil prices will suffer the same fate as whale oil prices. So she's comparing oil to whale oil, and she's saying basically it's going to fall. So is she right? It's a function. Yeah.
She's a very smart person. And she's done very well at what she does. Their narrative. If I'm not mistaken, it's not about making money today so much. They had a tremendous year last year, and that got them a lot of attention, but it's more about, where they're going to be in the next 10, 20, 30 years. And listen, I don't think crude oil is in the need for the petroleum is going to go anywhere in the next decade. But you are seeing here, these are policy decisions in Washington. These are policy decisions from OPEC. These are policy decisions in Europe, and that is driving these prices higher. It's not a coincidence that you have a Democrat office and you have oil prices, higher, multi-year highs, basically. And I think there is higher to go on a technical basis in the near term. To this weakness on this week held 73.5 to about 73.90 was a big level that we wrote in our morning notes to clients to watch for, and it proved to be a buying opportunity. We got a little bit of a fundamental help yesterday when China told their energy companies to get supplies at any cost. And we're seeing crude hang up here above 75 for much of the day, even though OPEC is talking about bringing back a little more production. I think what's offsetting OPEC's talk yesterday about bringing back more production is this Delta variant subsiding. COVID's still there, and in some of the countries are still battling it at some of the worst conditions they've had. But at the end of the day, the vaccines are people are vaccinated, or they've had COVID, and there is basically a herd immunity that is taking place right now. And then you got the news with Merck with the pill to give yourself safety before potentially coming across COVID. So I think what we're seeing here is a welcoming of demand on the energy side, because travel is going to pick back up. Yeah. You're also going to see some bottlenecks that are going to subside, and that's going to create additional demands. So I'm very bullish on where crude oil can be, and I'm not the only one, because you've got Goldman Sachs saying a cold winter is going to get you above $90, and Brent was above $80. We're backed off a bit. You're 78.5 here today. So I remain very bullish as long as the landscape remains technically constructive.
Well, we're already almost at $80 on the WTI. Can we see 100 anytime soon?
I've been saying this. I think I was on your show a couple months ago saying I will not be surprised to see $100, and I think it's very likely we could see $100 over the next 12 to 18 months, meaning through the first half of next year, or potentially at the latest end of 2022. I think that's what we're going to see. I think this, again, for all the reasons I just stated, that we're going to see. I mean, it's the reopening of the reopening, basically. I think we're going to have here in the next couple of months.
Okay, let's talk about monetary policy and the precious metals now. Touching on the Fed, last time we spoke was in August. Now, we did have one more Fed meeting in September since then. And one thing that was interesting to me was that if you look at the dot plots in September, in the last meeting, you had 9 Fed members thinking that a rate hike would happen next year, and 9 Fed members thinking that a rate hike would happen in 2023. So it was pretty evenly split on 2022 versus 2023. Now, that has shifted, because before September, more Fed members thought that a rate hike would only happen after 2022. So the sentiment has started to shift to an earlier rate hike timeline. What do you think? Do you agree with what this change may signal?
I've overall been, a Fed applauder, and I have criticized a bit, I think it was June, after how they quickly raised those inflation expectations before really getting the third read. But overall, I've applauded what they've done, and what they've done here with the taper that's coming. And then I'll get to answering your question, because by answering this question too. Sure. And what they've done is really get the market is very ready for this taper. It's well prepared, and on top of that, talking about Congress for a second again, there is an argument here that we could see net issuance decrease if Congress doesn't really need as much money as initially anticipated a few months back. We could see net issuance from Treasury, not as much as initially anticipated, and the Fed's buying less, which really, but there's a net decrease overall. So that really stabilizes risk assets. So that's something that I think you're seeing this work together very well. And so the fact, again, now to answer your question, the Fed has brought those expectations up a little bit. They are probing the market, and they are setting those expectations at a time that it can be set. I think they've done a good job. And will they be able to raise rates at the end of 2022? I don't think so. But that is a reason, and this may go into your next question. That's the reason why I like gold, and I think it's one of the reasons why those expectations have kept gold under wraps. But now I think that once those expectations are proven that they really can't do that, gold's going to shine.
You read my mind. That was my next question. So gold has been held back by, you mentioned, rising Treasury yields, and of course, a strengthening U.S. dollar. The DXY has been continuously going up. Now, Bill, can these forces reverse? We'll need them both to kind of stabilize downward before gold can see any sort of bid, right?
Yes. Yeah. Now, touching the Treasuries here, I was on Fox Business earlier this week, and everybody's talking about the 10-year, 2% in the 30-year, and 1.5% in the 10-year. I said the levels you need to be watching actually are about 205, 206 in the 30-year. You have the 200-day moving average and another technical indicator there, and that's on the rate side. And then on the 10-year, it's more about 155 to 157, and these were really the highs of the day of the week, and the market, and these the prices have buoyed, but the rates have obviously they've backed off now, and that's given a little tailwind to gold here this week. Silver flushed out, and gold really held. And I've been talking about it going back to yesterday. In my morning note to clients, said that silver flushing out was really the needed cleansing, and I really like the fact that gold held against the August 9th to August 10th, the price action there in that low at 1730. And that my morning note on gold does get posted to Kitco once or twice a week. But it's you can sign up for it on our website. But that price action I thought was very constructive, and silver did that cleansing. Silver was battling against $22 day in and day out. It needed to see what's under there, and now with the rate story rates backing off. And then now talking about the dollar, bringing the dollar into the mix, the dollar is backed off from the highest. It is not uncommon to see a currency ram into the end of the quarter, and especially the dollar ramp up into the end of quarter three. Now, I think that was a little bit of safe haven from Congress. The dollar's backed off, and we're about a $0.5 index is 0.5% off of the high of the week. These have brought great tailwinds to gold and silver, very technically constructive, and gold. And then even though we got the wash down silver, 21.10 to 21.25 is a massive support level in silver, and buyers stepped in front of there. So I today, what we started getting work with clients to get long exposure yesterday. When we like that, we added to long exposure today. We like doing that through selling put spreads that expire for the November contract, which expired at the end of this month of October. Selling put spreads, you can look at something like a 1740, 1730, 1740, 1710. In November gold futures, you can sell that put spread, turn around and buy December, or even go farther on, go buy January call spreads and look for that as what's called a risk reversal, something similar in silver. We're actually selling in the money put spreads in silver. I think we're going to see these markets move higher. I think we'll see the dollar continue to go lower, and I think gold and silver can capitalize on just a stable environment in the treasuries. I don't think the treasuries have a reason to go either way right now. If they could just consolidate at these levels, it's going to be, I think, very bullish for gold and silver if the dollar backs off.
Excellent. Great updates. Thanks, Bill. Thanks for coming on today.
Thank you for having me.
And thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and follow me on Twitter at DavidLin_TV.